It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Stocks sliding ahead of the U.S. jobs report with geopolitical tensions bolstering oil's gains. We've also had a flurry of Fed speakers, with one official suggesting no rate cuts this year. Samsung's profit rebounding in the first quarter thanks to a turnaround in its chip division and strong smartphone sales. Also ahead, our exclusive with Argentina's President Javier Milei as he turns from hardliner to pragmatist in relations with China. Plus, a big lineup of guests this hour, including the president of global satellite provider Viasat, and we preview the upcoming RBI decision with Credence Family Office. And to markets we go. It is risk-off. Asia under some pressure ahead of the non-farm payroll expected out of the U.S. Numbers set to be pretty hot. 200,000 new jobs in March, a further sign of robust activity, perhaps justifying a delay in the Fed's rate cut. Geopolitics also in play, weighing on sentiment, driving oil to breach $90 a barrel. Meantime, Fed speak, Minneapolis Fed President Neil Kashkari, as we said, saying perhaps there may not be any rate cuts this year if progress on inflation stalls. China, Taiwan, Thailand on holiday, but we're on watch when it comes to the Chinese yuan, 725.22, pretty flat versus the USD. Japan, losses for the Nikkei, the yen extending gains after rallying the most in a month. It is about haven play on the back of those geopolitical risks. In terms of the S&P, ASX currently down about 1%, extending the declines for the day. And markets will be closely watching the March U.S. jobs report for more insight into the Fed's next steps. Expectations are for declines in both the top-line non-farm payrolls figure and the unemployment rate. This follows the latest weekly jobs claims data, which topped estimates. However, officials, including Minneapolis Fed President Neil Kashkari, are preaching patience on rate cuts.
Wouldn't say they're off the table, but they're also not a likely scenario given what we know right now. If we continue to see strong job growth, if we continue to see strong consumer spending and strong GDP growth, then that raises a question in my mind, well, why would we cut rates?
Our next guest says the dollar faces downside risks with looming Fed cuts. Joining me now is Charu Chanana, head of FX strategy at Sexa. Good to have you with us. First off, no rate cuts, a possibility or not?
Hi, Haslinda. From the lens that I see it, as of now, Kashkari's comments are a little bit of an outlier compared to what we've heard from the other Fed members. And like you rightly emphasized, right, if inflation runs higher, that's the big if. We have obviously seen inflation going higher for 2 months in a row. But what Chair Powell says for now is that it is a bump in the disinflation path. Of course, where oil prices are, it is a little bit of a concern where inflation could go from here. But my sense is that oil prices are a little bit of a less concern for the U.S. economy, and they could obviously shift focus more towards core inflation to kind of, ward off those risks. The real threat for the U.S. inflation is actually coming from the housing side, and that's something that needs to be watched. But I wouldn't be concerned about not getting rate cuts this year as of now, because Kashkari doesn't vote, and he is a known Uber hawk in the committee.
He has been wrong before.
Well, the whole dot plot has been wrong before, right? So it's hard to say where it leads to. But right now, the whole outcome of this disparity in commentary that's coming out of the Fed is that there is really no consensus, and it really goes back down to the fact that data is really all over the place. So we are just continuing to be back to be, data dependent.
Charu, you're not concerned about oil prices. Why not? Bearing in mind, it was oil prices that prompted the whole inflation crisis in the first place for the world. And we've seen oil surge in a very short period of time. If $90 a barrel is not a concern for you in terms of inflation, at what oil price would you start worrying?
I mean, why it is not a concern, specifically for the US, I would say US is an oil exporter right now. So for them is not really a problem. It certainly is a bigger problem for the Eurozone if we continue to see oil prices going up from here. But fundamentally speaking, the OPEC plus cuts that we've seen are actually voluntary cuts. They still have a lot of spare capacity. And if we do see oil prices heading towards that $100 per barrel mark with elections in the US coming over, I would think there would be reasons for the OPEC plus to reconsider those cuts that they have in their production right now. So yes, I mean, it certainly is very high levels of oil prices right now, but it's totally because of the geopolitical premium that is in place, and it's very hard to kind of price in that into the oil markets. And that is what really makes me feel that, you know, with that kind of spare capacity, it's and with the elections coming over, I mean, I think.
So Kashkari may not be right by saying that there may not be any cuts this year, but could we see a Fed that cuts rates either in June or July, but pauses after that?
Yes, I think that is a real hawkish possibility. I don't see how the Fed is able to postpone the start of its easing cycle beyond June or July because of, you know, they need to save their credibility and they don't want to be seen cutting to rate to the US elections. But yes, if we do continue to see the amount of resilience that is there in the US economy, it continues to surprise us. I mean, the recession concerns have not materialized, and I do see that the US consumer looks a little bit better now compared to what they were in the fourth quarter of the year. There are certainly some risks from, you know, the commercial real estate side or the high levels of debt that is there in the economy. But if we continue to see this economic outperformance, I do think we could move the expectations of rate cuts for this year from 3 to 2. But the start of the easing cycle still has to be, in my opinion, June or July.
Charu, if you're right, we're looking at USD exceptionalism dwindling away. How best to play the FX market right now?
I think, you know, it's the second quarter, in my opinion, is going to be a tale of two halves. You know, for the first half, we are continuing to see that pushback on rate cut pricing a little bit because US economy is still holding up a little bit. And on a relative basis, it does seem like the central banks from Europe, you know, you look at the Swiss National Bank, you look at the Riksbank as well, which is now signaling a May cut, you know, even the ECB and the Bank of England, they may be the ones to start cutting earlier than what the market is pricing in, and many of them even earlier than the Fed, as the Swiss National Bank has already done. So that means that the dollar could be stable to higher, whereas the currencies of the, you know, European countries, they kind of suffer a little bit more. But things would, I think, really take a turn around in the second half of this quarter when I do see, you know, that US exceptionalism really fading away and an urgent need for the markets to start to price in rate cuts because we've already priced in much of the pushback that has come through for now.
You talked about the Swiss National Bank. People are now saying that the Swissy is the carry trade.
Yep.
What's your thoughts on that? And how about the yuan carry trade? What happens to it? What happens to the yen carry trade?
So as long as volatility is low, certainly carry trades remain in demand. And all three of these that you mentioned are very interesting. The problem with yen and Swiss franc is that the positioning is already extremely short there. And that's why yuan is where now the markets are really testing the grip of the Central Bank of China, whether they continue to hold it off. I think from a very macro perspective also, it seems logical to expect that the Chinese authorities wouldn't mind a weak yuan to really kind of, you know, help them get that boost on exports, which is the only driving factor for the economic growth right now, given consumption is where it is, property sector issues continue to stay there. But you know, for me, I think going into the second quarter, the concern is really about can volatility remain as low as it has been all this while, given geopolitics, given again the election risks as well. And if there is a little bit of a spike in volatility, we all know that, you know, carry trades, they reverse very, very quickly. So I would be on guard for that.
So in terms of conviction calls, what are the best crosses out there?
I would think sterling is quite a good, interesting pair to look at because as much as, since the start of the year, the story has been around how the Bank of England could be late to join the rate cut party, it is quickly turning around now. And I think Q2 will be a story where UK's disinflation narrative really comes to the forefront because we've seen their wages going down quite materially. Not quite there back to the target yet, but the downturn has been quite material, and Q2 will be the the months where we see most of that coming through. So we need to price in a more aggressive easing cycle for the Bank of England compared to some of the other central banks, and that's why potentially the sterling could continue to face some pressure.
Great insights, Charu. Thank you so much for that. Charu Chanana, head of FX strategy at Sexo. She expects that rate cut to come either in June or July. Just to give you a headline out of China, where Janet Yellen is visiting for the second time in several months. Yellen now seeking healthy, in her own word, Yellen seeking healthy China ties, warning about overcapacity. Of course, these are the issues that she is expected to speak with her counterparts in China. There you see on your screen Yellen this morning making her way to China, and we'll bring you the very latest from the ground from our correspondent there. Now, still ahead this hour, our exclusive interview with the president of global satellite communications company Viasat. We discuss their business strategy for the APAC region and their recent acquisition of Inmarsat. But first, our exclusive with Argentinian President Javier Milei as he strikes a more pragmatic tone on China after previously calling the country an assassin. That is next. Keep it here with us. This is Bloomberg. Welcome back. Argentinian President Javier Milei is striking a more pragmatic tone when it comes to China. Just 6 months ago, he had threatened to curb ties, calling the Asian nation an assassin. Milei spoke exclusively with Bloomberg's editor-in-chief, John Micklethwaite.
As for the Chinese government, what we've always said is that we are libertarians. And if people want to do business with China, they can carry on business as usual. What I said was that I wouldn't be aligning with communists. And that's precisely one of the things. Who did I say I was going to align with? The United States and Israel. Do you have any doubt that that's my alignment, United States and Israel?
No, but in fact, you have a very good example at the moment, and I'll come back to Israel and the United States later. But now, as you know, in Argentina, the focus is on a Chinese space station in Patagonia that your predecessor allowed to get built. The US says that the space station has military purposes. Will you close it down?
Well, the point is this. Negotiations are beginning to audit and inspect that, because the Chinese say that is not the case. So we will move towards a situation, we will be looking at that, so that is not a problem either.
Is a factor in this the fact that you have that $18 billion currency swap line with China, which you do need? You need it for the reserves at the central bank. It's a big portion. Does that influence your thinking on China?
That situation has to do with an agreement that was entered into and which has to do with the trade exchanges between countries. I won't modify trade exchanges because I think they're trade exchanges between privates. Just as we have a part in our central bank, they have, of course, their central bank counterpart. I don't see a problem. And honestly, the trade relations haven't changed. Not a problem.
The problem would be if I was the Chinese government and you called me an assassin, I might be less keen to renew the currency line.
Have trade relations changed? They haven't. Not one bit. So that is actually counterfactual. There's no truth.
Argentinian President Javier Milei speaking exclusively with Bloomberg editor-in-chief John Micklethwaite. And we'll have much more from that conversation, including his views on Israel and the U.S. coming up later on Bloomberg Television, online, and on the terminal. Subscribers can get more right now at NI Big Take Go. Now, here are some pictures from U.S. Treasury Secretary Janet Yellen's meeting with business leaders in Guangzhou a short time ago as a week-long trip to China gets underway. Yellen earlier this hour commenting she seeks healthy ties with China while warning on overcapacity. We'll have more details on her agenda in just a moment. But first, a team of Bloomberg economists also recently made trips to Shanghai and Xi'an for meetings with businesses as well as locals. David Chu was among them and joins us now to talk about his key observations. David, what were some of your impressions from that visit?
Overall speaking, people are still conservative about the economy outlook. Although we saw a rise in the PMI in March, this recalls what happens last year when we also saw the rise in the PMI in the first couple of months, but then the economy softened in the following quarter, so that the underground survey and the feeling tells us that we should still be cautious about the reading of the PMI, so that that is the feeling from the investors with the trip.
So what do you make of that divergence between the PMI data that you talked about and on the sentiment on the ground that you're seeing? Is there a reason for the government to address that? Is the government looking at it the same way?
Well, I think this time the government can be also conservative or cautious about reading it as a strong rebound because as I cited last year's experience, so that I think the government should continue to boost the economy with more stimulus to avoid repeating the misstep in last year.
You also talked about how investors are still conservative in their asset allocation. Why is that? What's your understanding?
Well, at the beginning, as I cited in the beginning, they are very cautious, still cautious about the outlook of the economy based on last year's experience. And another reason is that they are looking at the long-term growth trend of the economy, and they think that the long-term trend or the long-term growth rate should be, we cannot expect it to be as strong or as fast as previous. So that was the reason behind them. As we cite that they were still in favor of the long-term government bond, because they think that the long-term growth should be slower than before, and they expect the PBOC to do more easing, not only in this year but also in the next couple of years.
So you talked about PBOC expected to do more easing. How aggressive might it be? How much of a possibility that we could see QE, for instance?
I think I know that there are a lot of talk or bet in the market that the PBOC is going to do some kind of QE. But I have to say, I have two comments here. One is that the PBOC is somehow different from other major central banks because the PBOC is always doing something in the quantitative side, because the PBOC has both the price side and the quantitative side tools in their toolbox. For the former one, we usually refer to the interest rate, and for the quantitative one, the PBOC has the triple R adjustment, and it also has the MLF and also PSL. These are all the tools for quantitative adjustment. Second is that the PBOC is worried about the debt, and we don't think that the QE can solve the problem of debt.
David Chu, Bloomberg economist, thank you so much for that. Now, U.S. Treasury Secretary Janet Yellen is in the southern Chinese city of Guangzhou, starting her 7-day visit. Bloomberg's Christopher Condon is traveling with the secretary and joins us now. Chris, who's Yellen met so far? What's been the tone? What's your own observation?
So far, she held a meeting this morning here in Guangzhou with a group of American and other Western or I should say non-Chinese business leaders whose companies are active in China. There were executives from companies in Europe, from Japan, and from the U.S. And then she went from that meeting and is right now in a meeting with Wang Weizhong, the governor of the Guangdong province, which of course is a huge commercial center in southern China. She's currently speaking with him. She had some remarks at the top. Some of them were very positive about wanting a healthy relationship with China. But once again, she hit very hard on the issue of what the U.S. is saying is industrial overcapacity in China, fueled by excessive state subsidies. She's hitting this at every opportunity. And I have to say, one other thing I picked up on is that the U.S. seems very keen to present this as not just a U.S. complaint, but that other countries around the world are also concerned about how overcapacity in China, especially as China's domestic economy has slowed, will begin to distort global markets. So I think that's why you had executives from Japan and Europe in on the first meeting this morning. They're kind of marshaling their criticism together in something of a coordinated fashion, I think, and want to present that to the Chinese in that way. So I thought that was quite interesting.
Chris, we know that this is the second visit in several months. Will Yellen accomplish what she set out to do, and just how significant is this trip?
Well, I wouldn't say that you should expect this to be a watershed in any way. We're not going to see major announcements at the end. There aren't going to be quote unquote, deliverables. They're here to make a strong case about this issue. They're here to have talks on a whole host of other issues that they've already begun talking about in these meetings, going back even before her visit here in July. I don't think, at the end of it, we're going to suddenly see some quote-unquote results. We're going to have to wait. I think she's not yet to the point where the U.S. is threatening, new trade barriers over this issue of overcapacity. It's not quite coming to a head yet. So it's going to take a little while, and then we'll have to see where it goes from there.
Chris, thank you so much for that. Bloomberg's Chris Condon, who's traveling with Janet Yellen. Plenty more ahead. Keep it here with us. This is Bloomberg. Samsung Electronics saw a sharp rebound in profit in the first quarter of the year. The world's largest memory chip maker says preliminary operating profit stood at nearly $5 billion, beating analyst estimates. The strong results reflect a turnaround in the company's pivotal chip division and the robust sales of its Galaxy S24 smartphones. It also snaps a run of consecutive declines that began in the third quarter of 2022. Let's do a check on how Samsung's faring along with other chip stocks. Samsung under pressure as we speak, down about 1.2%. Revenue, though, coming in short of expectations, despite the fact that we're seeing a turnaround for the chip sector. SK Hynix, Tokyo Electron also in negative territory. In fact, Tokyo Electron down about 5%. Flip the page, take a look where we are in terms of energy stocks as well, on the back of oil surging past $90 a barrel. Those stocks currently trading higher. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. China on holiday for a second day, but Hong Kong is open. We're taking a look at Hang Seng Index, currently down about 1%. Our gauge of Chinese stocks listed in Hong Kong falling amid broader risk of sentiment across Asian markets, dragged by U.S. interest rate uncertainties. China 8 shares currently down by 1.5%. H Tech currently down by 1.7%. And that property index also in negative territory. So pretty much red across the board. In terms of the Nikkei 225, it is coming back from lunch break very shortly. Losses for the Nikkei as well, in line with the rest of the region, down 2.5% as we speak. It is about the yen, by the way, extending gains after rallying most in about a month, and that's weighing a lot on exporters, the likes of Honda, now pulling back from levels that prompted intervention speculation. The yen boosted by haven play on the back of geopolitical tensions that we're seeing in the Middle East. The Nikkei 225 extending its decline to about 2.5%. The topic's also down. JPY 151.24 versus the USD. Currently just a tad lower versus the greenback at this point in time. And we have Thai inflation to tell you about, falling 0.47% year on year. The estimate was 0.13%. Of course, Thai inflation has been in focus, down for 5 consecutive months, prompting the likes of the the government to persistently ask the BOT to start to cut interest rates. Thailand March core CPI rising 0.37% year on year. The estimate was for a rise of 0.4%. So missing, in fact, lower than what was estimated, perhaps drawing a bigger case on the part of the BOT to start thinking about cutting rates. And we have yet another line out of China. Yellen heard that overcapacity concerns in some Chinese industries. Of course, this is on the back of her visit to China, her second one in several months. We'll bring you the very latest as they come along. Now, to the business of space-based communications, US-based Viasat acquired the UK's Inmarsat for $4 billion last year, creating the world's biggest geostationary satellite company. It is a response to the challenge from Starlink, a network of internet beaming satellites operated by Elon Musk's SpaceX. Joining us exclusively now here in Singapore is Viasat President Guru Gaurapan. Guru, good to have you with us. The last time we spoke, you were heading another company. What brings you to Singapore? You're using Singapore as a hub.
Singapore is a very core market for us. If we think about Viasat, we've been focused on maritime, aviation, and government business as the segment. We're leaders today in maritime and aviation. If you look at it, we have almost 56% market share in maritime on satellite communications more broadly. And Singapore is one of the largest hubs for us. A lot of key customers, as you know. Shipping and maritime is fairly massive. We have a large team here, which is mainly legacy Inmarsat. But as Viasat, now we are focused on expanding that as you think about aviation, maritime, and other businesses.
You talked about how the merger gives you the scope and scale to expand and perhaps, to compete even better against your competitors. I mean, give us a sense of the scope and scale and what can be expected. What will that translate to?
See, first, it's a very exciting time to be in space and satellite industry more broadly. The market now is growing roughly at 12% CAGR to about $108 billion by 2030. So you have players coming in. It's an exciting time. What it does for us when you think about Inmarsat and Viasat, now we have global coverage with high capacity that Viasat brings into play. So we have now about 19 satellites that are operational. We've got 7 new coming in between Viasat and Inmarsat. As I mentioned earlier, maritime is a big play. Aviation, we have roughly 40% market share globally. Players like Singapore Airlines, you name, Singtel is a big partner of us. So what it does for us is really expanding globally and bringing those two networks together.
But how much of that market are you targeting now? That you're a bigger player, surely you can secure a bigger part of that market.
We are already, I would say, takes APAC as an example, only 20% of aviation market has connectivity. So you're still starting. And that landscape today, all the airlines want connectivity as an example. All the maritime customers want high-speed broadband connectivity. So our job is barely starting. So that's why the growth rate is one of the exciting markets.
Of course, Elon Musk, Starlink, up in arms against the merger. I mean, does he have a case that it is anti-competition?
The key is the market's large enough for multiple players to exist, right? So it is, in our view, he's got an aggressive play about how they're approaching it, different from a LEO perspective. We are more of a geo-based, satellite providers. And as I said, the market's expanding enough that there will be multiple players who can have share in that. So we didn't see a case, and that's hence the reason why the merger was approved. I think it's good to have competition. We actually enjoy it. It enables us to build more great products in the end, the customers win, right? Because you have more choices.
Is it right to say that, the likes of new players in the satellite space, like Starlink and OneWeb, are in fact forcing consolidation within the industry so that they can look at competition differently and perhaps with more confidence?
Well, I would say there has. I mean, we've been going through, like, we acquired Inmarsat, so there is some consolidation that's happening. But again, the expansion of the market is still key, right? And there are certain players who will be focused on certain geographies. OneWeb maybe positioning that way. Starlink's more focused on fixed broadband today, not much in aviation or even maritime when you look at the market. So I would say there are multiple segments that some of the players will play a better role than new players coming in. But the service quality is what the customer, for us, we focus on enterprise customers. So having an enterprise-grade product matters a lot. It's not just consumer side, but working with an aviation player or a maritime player. And then the other big piece I would say versus LEO versus GEO, what we do is being capital efficient. When we can cover the entire Earth with 3 satellites, right? So you think about a LEO satellite, you get 100 kilometers kind of a viewpoint. So a lot of that is what now customers want, that capacity, call it density economics, that matters a lot, having that flexibility. And then space sustainability is a very key part as well, because you can't have tens of thousands of satellites up there in space. The resources are still limited, versus when you think about a GEO player, we are trying to do this as efficient as possible.
You talked about several sectors, maritime, aviation. In terms of Asia, which are the growth markets? Because when it comes to maritime, you have China, you have Singapore, you have Malaysia even playing a huge role in that.
I would say pretty much all of Southeast Asia, and including even India, if you take South Asia as well, China, this is a massive market, and the connectivity business has just started. Aviation, if you talk about, we talked about Singapore Airlines, but you take Cathay, you take Air India, which is going through a massive expansion in India. You have the same massive players in China as well. All of them are just getting started. I think in the US, similar model. I think we've gone through a good expansion there as Viasat. Now, the future, again, we are also thinking about direct-to-device. That's just getting started. As you think about L-band and narrowband direct-to-device, that's supposed to be in next 5 to 7 years, about $120 billion market. This is connecting direct to mobile phones. And you've seen many players already. Apple has done some work there. We actually have one of the largest access as you think about L-band. That's going to layer in. So you start having multiple use cases that start stacking up, not just aviation and maritime, but beyond that as well.
How will satellite change these industries? I mean, if you were to look into the future, of course, we're talking about perhaps free and available, good quality Wi-Fi on planes. I mean, how will satellite change these industries?
The first and foremost one, when we talk about our mission, is connecting the unconnected. So now you have 2.7 billion people globally who are not connected today. They have no connectivity at all, right? Satellite will play a very important role in bringing connectivity to all those people. Then you layer in places where you don't have connectivity. Take airlines, take ships, middle of the ocean, where it's not just broadband connectivity, it's also essential and for emergency service, life-saving in many ways. So satellite plays that core underlying. We always talk about now, you talk about food, shelter, and water. Connectivity is now 4th core human need when you look at it. Satellite, I think, is going to be the leading player in that. And it's not just about the internet connectivity, right? It's the layers of, call it, ecosystem that we bring in. Today, as an example, in aviation, one of the things we build in is the ad ecosystem. So who would have thought? So one of the things we say, bots don't fly. So you don't have bad quality traffic that happens in a plane. So we can have much better quality for an advertiser who wants to interact with the consumer. Airlines love that solution. In the shipping world, there are a lot of enterprise-level software systems that the shippers want. I'll give an example. Think about route economics, right? On an aviation today or shipping, they all want the best route from a climate change perspective, that you're not burning a lot of fuel. All of that needs a lot of data, real-time data that can help them reroute in a real-time basis. On aviation today, I think we save airlines roughly $4 billion in fuel cost, and about 40 million minutes are saved on aviation. So same happens on shipping as well. So connectivity is the base layer, At least what we do with it in terms of engagement and monetization is where the next step, that satellite is going to bring in.
There's an increasing number of players within the satellite space. Do you see further consolidation, and is restructuring inevitable?
I would say market's so nascent right now still with the growth. I think a lot of players will focus on much narrower use cases. We are broad and deep as we exist as a large player. I think at some point, people who specialize in certain areas, there might be certain consolidation. But for now, I think we're all following our own strategies, given the market is large.
All right, all prepared for competition. Guru, thank you. Great to have you with us, Guru Gaurapan, President at Viasat. Well, coming up, we preview the Reserve Bank of India's rate decision. Hear why Credence Family Office expects its easing cycle to only begin towards the later part of the year. More on the outlook next. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching India Focus. India starts trading in just 3 minutes and futures pointing to a flat open. Now, India's central bank is releasing its latest policy decision in the next hour. Economists surveyed by Bloomberg expect the RBI to keep rates unchanged for a 7th straight policy meeting. For more, let's bring in our India economy and government reporter, Shruti Srivastava in New Delhi. Shruti, why is the RBI expected to stand pat?
Expected to keep its benchmark repo rate unchanged, and as you mentioned, this would be the 7th policy meeting where the RBI would be keeping its policy rates unchanged. Now, that is primarily because of 2 factors: high inflation and high growth. Inflation is higher than the RBI's target range of 4%. In fact, the February numbers show that the consumer price index was at 5.09%, which is much higher than the RBI's targeted range of 4%. And RBI's Governor Shaktikant Das has repeatedly said that RBI is not going to start easing anytime before the inflation comes at the 4% target rate on a durable basis. So that is number one reason. The second reason is, of course, higher growth. India remains one of the fastest growing major economy in the world, and it is expected that India is going to clock 8% or more growth for the full year, for the fiscal year that just ended in March. So that is another reason which gives RBI some comfort. And of course, the third reason I would say is the possible indication by US Federal Reserve of a delay in rate cut. I think that gives RBI some breather on monetary policy easing. I think these factors would guide RBI's decision today.
Right. So the key question still remains, when will we see a rate cut by the RBI? Some say not till the end of 2025.
Yes, so some of the economists have, yes, you're right, they have pushed back their forecast. They have pushed back their forecast for a monetary policy easing from June to later in the year by October. Again, the reasons are 2. One is, of course, higher than expected growth rate. India, as I mentioned, is one of the fastest growing economy. And there is optimism that India will clock 7% plus growth in the current financial year. And the other thing is the prediction by the government on hotter than usual temperature. There are the predictions by the government's meteorological department that April to June period is going to see a heat wave across the country, and that may impact inflation. That's why some economists believe that the process of disinflation is going to slow down a bit because of the heat wave concerns, and perhaps that is something RBI would be watching out for and would be cautious about, and that's why some economists believe that the rate cut, the monetary policy easing is not happening anytime soon.
That's right. Wait and see. We have heard that before. India economy and government reporter Shruti Srivastava in New Delhi. Thank you. India's starting its trading session in just momentarily. We're seeing the the Indian rupee trading 83.42 at this point in time, pretty flat against the greenback. It has been pretty resilient versus the USD. Sensex under pressure like the rest of the region, down 0.2%. The other benchmarks in India also under pressure. Let's Get more on RBI's rate decision, rate direction. Bring in Chanchal Agrawal, CIO of Credence Family Office, a wealth advisor with over $1 billion in assets under administration. Chanchal, good to have you with us. We heard from Shruti earlier, the RBI set to push back its first rate cut. What are your thoughts on when it is likely to move?
So likely, I mean, a couple of countries like Brazil, Mexico and Switzerland now have started announcing rate cuts, and I think likely US is not in that contour area. Unfortunately, India is tied to US on the hip. So on the overall macroeconomic factors, India is still quote unquote linked to US, and overall you've seen inflation still being high. You've seen growth factors very strong both in US and in back in India. One of the important considerations here would be oil. Oil is close to $90 a barrel. I think at this level there is still some comfort, but if oil catches up soon, then your inflation prints, your food inflation all starts picking up high. That leaves very little scope for RBI to announce a rate cut decision anytime soon.
Chanchal, if oil continues to surge higher, how might that influence and shape your thinking in terms of where you invest the money? That aside, right, macro factors aside, of course, we do understand oil always has been an overhang. The second overhang for somebody like India is being China. China, I think, is going on an easing spree where President Xi has asked PBOC to start infusing money into the system, start buying government bonds. If China starts slowing down from here, starts easing, I believe a lot of liquidity, market liquidity will start going back to China, and largely given the fact that all real estate concerns are known and factored in. So I think that's one big risk for somebody like India in the shorter term. In the longer term, I see a lot of money getting pushed to the new Bharat, to more consumption-driven themes, to see what government is doing next. So these are the two macro themes that I have in mind. Right. And venture investing, how is that coming along as a theme?
Sorry, could you repeat that question?
Venture investing, where are we with that?
So venture investing in the past 2 years have seen some kind of winter season, but interestingly, I think in 2023, the interesting part that happened was you see almost 1.7x of exits. So you saw almost $6.6 billion of exits in the system via IPOs, second round of fundings, etc. Also, venture capital investing has matured over the years. So earlier it was largely centric to fintechs, consumer fintechs, etc. Venture capitalists now are looking at the new growth India initiatives. So, is that something happening in power, in solar, in consumer tech, etc. I think venture investing has matured over these years, and I see them investing into new India sectors soon.
We know that India is pushing Gift City in a big way. How are you, I guess, encouraging or advising your wealthy clients to do?
So I'll talk about outbound, where wealthy clients need to invest out of India, right? So traditional, the option available to them was a simple LRS. With family investment fund coming in, they can now diversify in a more meaningful way outside India. I still understand that there are some regulatory overhangs around that, clarity of what could be an OPI structure versus what could be an ODI structure. It's still remaining. Couple of initial filings over there is still in the process. I think we'll wait to see how that spans out and what is the response that they get in the system before we start working and advising our clients on that. But it's an amazing initiative.
There is intense competition in the wealth space. We know that for a fact. I mean, how is that impacting independent wealth advisors like yourself?
In fact, the pie is only growing bigger. So I know all of us know the stats where, the financial investment concentration in India by itself is close to 3-4 odd %. I think the pie itself is growing larger, where you have a lot of investments coming from tier 2, tier 3 cities, a lot of know-how given the whole mutual fund sahi hai, initiative by Amphi. I think that's growing the pie much larger to absorb all the new independent advisors that are coming in. I would want to believe that there are close to 1,200 HNIs with more than 100 million of portfolio. This number is only going to double in the next 5 years, right? So there's ample growth and ample elongate in the pie happening. So there's space for many more of us to come and start working on this.
But are you thinking about new products to attract new clients for the money?
I think that's right. Yes, that's right. The whole credit space in India is still very underdeveloped. Back in US, you have a lot of high-yielding investment opportunities for HNIs, for retail masses. Here, the credit space was earlier limited to the debt mutual fund, but after the whole credit crisis, I don't think debt mutual funds are also actively participating in the high-yield scenario. For HNIs, you still have AIFs, but what happens for retail clients, guys who are somewhere in the middle? I think there is a lot of scope to fractionalize the credit investment ideation in India. You could have structures like SDIs, which is more of a pooling structure, allows you to bifurcate units across different papers to individuals. I think SDI is one thing which could help broaden the credit space in India.
Chanchal, thank you so much for that. Have a great weekend. Chanchal Agarwal, CIO, Credence Family Office. Of course, India has started trading. About 6 minutes from now, it is under pressure, like the rest of the region, ahead of that non-farm payroll. Plenty more ahead. Keep it here with us. This is India. This is Bloomberg. Now, the top geopolitical stories we're following. President Biden has told Israeli Prime Minister Benjamin Netanyahu that U.S. support for Israel's war in Gaza depends on new steps to protect civilians. Biden's warning comes after an Israeli strike killed 7 people delivering food to displaced Palestinians in Gaza. The U.S. leader is facing increasing pressure to take a hard line against Israel as civilian casualties rise. Israel is scrambling navigational signals over the Tel Aviv metropolitan area as the country prepares for a potential Iranian attack. The measures were taken to disrupt GPS-navigated drones and missiles that Iran or its proxies might fire on Israel. Tensions have soared between both sides following a missile strike which killed senior Iranian military officials earlier this week. The French and Russian defense ministers have held a rare telephone conversation on the war in Ukraine. The defense ministry in Moscow says there's a readiness for dialogue on Ukraine, but the French readout did not mention any possible talks. Meanwhile, NATO members are reining in expectations about a proposed $100 billion fund to support Ukraine, as floated by Secretary General Jens Stoltenberg. And you can watch our interview with the NATO Secretary General on Bloomberg TV this Friday, as the alliance marks its 75th anniversary. That's happening on Bloomberg Surveillance at the times on your screen. Let's get to markets, do a check on how it's shaping up for India ahead of the RBI decision. It is expected to stand pat. That sizzling heat wave in large parts of the country will raise concerns for India's policymaker. Nifty index down 0.2%. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. Keep it here with us. This is Bloomberg.